Ever wondered why prices keep going up? Why interest rates suddenly change? Or why some countries seem to grow faster than others? Well, that's macroeconomics. Macroeconomics might sound like a complicated word, but in reality, it's simply the study of the economy as a whole. Instead of looking at one person, one company, or one product, macroeconomics looks at entire countries and millions of people at the same time. It focuses on big forces like inflation, economic growth, unemployment, interest rates, government spending, and currencies. These are the forces that shape how an economy moves over years and decades, not days. Now, to understand macroeconomics better, it helps to compare it with microeconomics. Microeconomics looks at individual decisions. It studies how consumers decide what to buy, how businesses set prices, and how supply and demand work in specific markets. Microeconomics explains what happens at a small scale. Macroeconomics zooms out. Instead of asking why one product is expensive, it asks why everything feels more expensive. Instead of focusing on one company, it looks at the entire job market. It's not about details, it's about patterns. And this is exactly why macroeconomics matters in your daily life. Because macroeconomics affects you whether you like it or not. Inflation affects your purchasing power. Interest rates affect your loans and savings. Economic growth affects your job opportunities and income. The good news is that you don't need to be an economist to understand them. Once you understand the basics of macroeconomics, economic news stops feeling confusing, and the world starts making a lot more sense. And that's exactly what this course is about. Welcome to Martik Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. To understand macroeconomics, you need to understand one key idea. The economy is a system. Everything is connected. Production, income, and spending are not separate things. They are different sides of the same process. When a company produces goods or services, it pays wages to workers. Those wages become income, and that income is then spent on goods and services again. This spending creates demand, which encourages more production. This loop is the foundation of the economy. If one part of this process slows down, the entire system feels it. If companies produce less, workers earn less. If people earn less, they spend less. And if spending falls, companies reduce production even further. This is why economies can slow down quickly when confidence drops. This idea is often called the circular flow of the economy. In simple terms, money and goods are constantly moving in circles. Now let's look at the main players in the system. First, households. Households provide labor. People work, earn income, and decide how much to spend and how much to save. Their spending decisions are a major driver of economic activity. Second, firms. Firms produce goods and services. They decide how much to produce, how many people to hire, and how much to invest. Their decisions depend on demand, costs, and expectations about the future. Third, the government. The government collects taxes and spends money. It provides public services, invests in infrastructure, and supports the economy during downturns. Government spending and taxation influence overall demand in the economy. When households, firms, and governments are all active, the economy grows. When one of them pulls back, the entire system also feels the impact. Inflation is one of the most important concepts in macroeconomics, and also one of the most misunderstood. When people hear the word inflation, they often think it simply means prices are high. But that's not exactly what inflation is. Inflation means that prices increase over time, and as a result, money loses purchasing power. If something costs $10 today and $11 next year, that doesn't just mean prices went up once. If this keeps happening year after year, that's inflation. If the price of a product goes up because of a temporary shortage, that is not inflation by itself. For example, if energy prices spike for a few months and then stabilize, that's a price shock. Inflation is when the overall level of prices keeps rising even after those shocks pass. This distinction is important because inflation affects long-term decisions, while one-time price changes usually do not. Now let's talk about purchasing power. Purchasing power refers to how much goods and services your money can buy. When inflation exists, purchasing power declines. The same amount of money buys less than it did before. If inflation is low and stable, this loss of purchasing power happens slowly. But when inflation is high, money loses value much faster. This is why holding cash for long periods can be risky in an inflationary environment. Even if the number in your bank account stays the same, its real value is shrinking. Over time, inflation pushes people to think differently about saving, spending, and investing. It changes how people plan for the future. Inflation sounds abstract until we try to measure it. To understand inflation properly, we need a way to track how prices change over time. The most common tool used for this is the Consumer Price Index, or CPI. The Consumer Price Index measures the price of a basket of goods and services that a typical household consumes. This basket includes things like food, housing, transportation, energy, healthcare, and other everyday expenses. Statistical agencies track how the price of this basket changes over time. If the basket becomes more expensive, inflation is rising. If prices stabilize, inflation slows down. Now it's important to understand the difference between inflation and the cost of living. Inflation measures how fast prices are changing. The cost of living measures how expensive life is at a given moment. A country can have low inflation but a high cost of living if prices are already very high. And a country can have high inflation but still be relatively affordable if prices started from a low level. This is why saying inflation is low does not always mean life is cheap. Now let's talk about why official inflation often feels different from personal inflation. Official inflation is an average. It represents how prices change for a typical household, but no household is truly typical. If you spend a large part of your income on rent, food, or energy, your personal inflation rate may be higher than the official number. If you spend more on items whose prices are stable or falling, your personal inflation may be lower. This is why many people feel that inflation is higher than what official numbers show. They are not wrong. They are experiencing their own personal inflation. To really understand inflation, we need to understand where it comes from. There are four main forces that cause inflation. The first is demand-side inflation. This kind of inflation appears when people want to buy more goods and services than the economy can produce. When demand grows faster than supply, businesses respond by raising prices. This often happens during economic booms. People have jobs, incomes are rising, credit is easily available, and confidence is high. The second cause is supply-side inflation. This kind of inflation happens when it becomes more expensive or difficult to produce goods and services. This can be caused by higher energy prices, supply chain disruptions, labor shortages, or natural disasters. When production costs increase, companies raise prices to protect their margins. Even if demand does not increase, prices can still go up because supply is constrained. The third cause is monetary inflation. Monetary inflation occurs when the supply of money grows faster than the production of goods and services. When more money is created but the economy does not produce more output, each unit of money becomes less valuable. This type of inflation is closely linked to central banks and government policy. Expanding money supply can support the economy in the short term, but if overused, it can lead to persistent inflation. The fourth force behind inflation is expectations and psychology. Inflation is not only economic, it is also behavioral. If workers expect prices to rise, they demand higher wages. If businesses expect higher costs, they raise prices in advance. If consumers expect prices to rise, they buy more today instead of later. These expectations can turn inflation into a self-reinforcing cycle. Once people believe inflation will continue, their behavior helps make it continue. This is why managing inflation expectations is one of the most important challenges in macroeconomics. In theory, wages should rise with inflation. In reality, they often don't keep up, at least not immediately. When prices rise faster than wages, your purchasing power falls. Inflation is sometimes called a hidden tax on savers. The longer inflation lasts, the more purchasing power is lost. Next is debt and credit. Inflation affects debt in a very different way. If you have fixed-rate debt, inflation can actually help you. Over time, you are repaying your debt with money that is worth less than when you borrowed it. However, inflation also leads to higher interest rates. New loans become more expensive, and variable rate debt can become harder to manage. Governments play a major role in the economy, mainly through how they spend money and how they collect it. Let's start with government spending. Governments spend money on many different things: healthcare, education, infrastructure, public services, pensions, social programs, and defense are some of the biggest areas. It shapes how the economy functions. When the government spends more, it injects money into the economy. Now, let's look at how governments collect revenue. These include income taxes, corporate taxes, sales taxes, and property taxes. Governments may also collect fees, tariffs, and royalties. This leads us to fiscal policy. When governments increase spending or cut taxes, fiscal policy becomes more expansionary. This is often done to stimulate growth during economic slowdowns. When governments reduce spending or raise taxes, fiscal policy becomes more restrictive. This is usually done to control inflation or reduce debt. Now that we understand government spending and taxes, we need to talk about deficits and debt. A budget deficit happens when the government spends more than it collects in revenue. A budget surplus happens when the government collects more than it spends. Deficits can be useful during recessions. When the economy is slowing down, private spending often drops. People lose jobs, businesses earn less, and confidence falls. In those moments, government spending can help fill the gap. By spending more or cutting taxes, the government can support demand and prevent a deeper recession. However, deficits become a problem when they are persistent and large. When governments borrow too much over time, debt grows. High debt means higher interest payments. Those interest payments reduce the government's ability to spend on important areas like education or infrastructure. High debt also increases the risk of a fiscal crisis. If investors lose confidence in a country's ability to repay, borrowing costs rise. That can create a dangerous cycle. The government borrows more at higher interest rates, which increases debt even faster. Now we move to one of the most important institutions in any economy, the central bank. A central bank is the institution responsible for managing a country's money and financial system, mainly through monetary policy. Examples include the Federal Reserve in the United States, the European Central Bank in Europe, and the Bank of England in the United Kingdom. Central banks are not the same as commercial banks. Commercial banks are the banks you use to save money, take loans, or pay bills. Central banks are the banks of the banks. The main responsibility of a central bank is to maintain price stability, which means keeping inflation under control. Central banks also focus on maintaining financial stability and supporting sustainable economic growth. Monetary policy includes tools like interest rates, reserve requirements, and open market operations. The most famous tool is the policy interest rate, which affects borrowing costs across the economy. When the central bank raises the policy rate, borrowing becomes more expensive. Banks pass on that cost to people and businesses, so loans, mortgages, and credit cards become pricier. This usually slows down spending and investment, which helps reduce inflation. When the central bank lowers the policy rate, borrowing becomes cheaper. That encourages people and businesses to take loans, spend more, and invest, which can boost economic growth. Interest rates are also a major driver of stock prices, bond prices, and real estate. When interest rates are low, investors look for higher returns in stocks and real estate. This often pushes prices up. When interest rates rise, bonds become more attractive because they offer higher yields. At the same time, stocks and real estate can become less attractive because borrowing costs rise and future profits may be lower. Finally, let's talk about central bank independence. Central bank independence means that the central bank can make decisions without political pressure from the government. This is important because political leaders often prefer low interest rates and high spending before elections, even if it creates inflation later. Independent central banks are generally more credible because they are seen as focused on long-term stability rather than short-term political goals. However, independence does not mean central banks operate in isolation. They still coordinate with governments and other institutions. If you would like to know more about monetary policy and interest rates, especially in the US, I have a dedicated video on the channel. Now let's talk about exchange rates and foreign reserves. This is where macroeconomics starts to connect with the global world. Exchange rates determine how much one currency is worth compared to another. For example, if the exchange rate is $1 equals 0.90 euros, then $1 can buy 0.90 euros. If that rate changes to $1 equals 0.80 euros, the dollar has weakened and you get fewer euros for the same dollar. Exchange rates matter because they affect imports, exports, travel, and the price of foreign goods. For example, if you live in the United States and the dollar weakens, buying imported goods like electronics from Europe becomes more expensive. But at the same time, American products become cheaper for people in other countries, which can boost US exports. So how do exchange rates work? Exchange rates are determined by supply and demand. If many people want a currency, its value goes up. If fewer people want it, its value goes down. For example, if a country is growing fast and foreign investors want to buy assets there, they need that country's currency. This increases demand and strengthens the currency. On the other hand, if a country has high inflation or political instability, investors may avoid it, reducing demand and weakening the currency. Now let's talk about fixed versus floating exchange rates. In a floating exchange rate system, the currency value is determined by the market. It moves freely based on supply and demand. For example, the US dollar and the euro are floating currencies. Their values change constantly based on global market conditions. In a fixed exchange rate system, the government or central bank sets a target exchange rate and tries to keep the currency around that level. For example, some countries peg their currency to the US dollar or to a basket of currencies. This can provide stability, but it requires constant intervention. This brings us to foreign reserves. Foreign reserves are assets held by the central bank, usually in foreign currencies, gold, or foreign government bonds. These reserves are used to support the currency and pay international obligations. For example, if a country's currency is falling too fast, the central bank can sell foreign reserves to buy its own currency. Now let's understand the difference between gross reserves and net reserves. Gross reserves are the total amount of foreign assets a central bank holds. Net reserves are gross reserves minus liabilities. For example, imagine a country has $100 billion in foreign reserves, but it also has $60 billion in foreign debt that must be paid soon. Its net reserves would be $40 billion. That means the actual usable reserves are much lower than the total number. Now we're moving into international trade, one of the most important parts of macroeconomics. Imagine country A makes cars and country B grows coffee. Country A exports cars to country B, and country B exports coffee to country A. Both countries benefit because they get what they need at a better price than producing it themselves. A very interesting metric is the trade balance, which is the difference between a country's exports and imports. If exports are higher than imports, the country has a trade surplus. If imports are higher than exports, the country has a trade deficit. For example, imagine a country exports $200 billion worth of goods, but imports $250 billion. That country has a $50 billion trade deficit. Trade deficits and surpluses are normal in many countries. They can be influenced by currency strength, economic growth, and domestic demand. A strong currency makes imports cheaper, which can increase imports and widen a trade deficit. A weak currency makes exports cheaper for foreign buyers, which can increase exports and reduce a trade deficit. Now let's compare trade surplus versus trade deficit. A trade surplus means a country is selling more than it buys. This can be a sign of strong global demand for that country's products. It can also mean the country is building up foreign reserves or investing abroad. A trade deficit means a country is buying more than it sells. This can happen when the country is growing quickly and consumers demand more foreign goods. It can also mean the country is investing heavily and importing capital goods like machinery. A trade deficit is not automatically bad, and a trade surplus is not automatically good. For example, the United States often runs a trade deficit, but it also attracts massive foreign investment. Meanwhile, a country can run a trade surplus but still struggle if it has weak domestic demand or high unemployment. What matters most is the context, why the deficit or surplus exists, and how it is financed. Now that we've covered international trade, it's time to talk about capital flows, the movement of money between countries. So why does capital move between countries? The main reason is returns. Investors move money to places where they can earn more, whether through higher interest rates, faster economic growth, or better investment opportunities. For example, imagine country A offers 6% interest on government bonds, while country B only offers 1%. Investors from country B will naturally move money to country A to earn a higher return. That's why capital flows often follow interest rates. But returns aren't the only reason. Capital also moves for safety. If a country faces political instability, high inflation, or a financial crisis, investors often move money to safer assets like the US dollar, gold, or bonds in more stable countries. So capital flows are driven by both profit and protection. Foreign investment is basically a vote of confidence. Now let's talk about public debt and country risk. Debt isn't just a number in a report. It affects interest rates, inflation, and the stability of an entire country. First, we need to understand the difference between domestic debt and foreign debt. Domestic debt is money the government borrows from its own citizens and institutions, usually through bonds in the local currency. Foreign debt is money borrowed from abroad, often in foreign currencies like dollars or euros. The difference matters because foreign debt can be riskier. If a country owes debt in dollars but earns most of its money in its own currency, a weakening local currency can make debt payments much more expensive. Next is debt sustainability. Debt is sustainable when a country can keep paying interest and principal without needing to borrow more just to pay existing debt. A country can have high debt and still be sustainable if it has strong growth, stable revenue, and low interest costs. But debt becomes unsustainable when interest payments grow faster than revenue, or when the economy is not growing enough to support the debt. For example, if a country is growing at 2% per year, but interest rates on its debt are 8%, debt will grow faster than the economy, and that can lead to a crisis. Now let's talk about country risk. Country risk measures the likelihood that a country will not be able to meet its debt obligations or will face economic instability. It's measured through indicators like credit ratings, risk premiums, and the cost of insuring debt. One common measure is the risk premium, which is the extra interest investors demand to lend to a country compared to a safer country. For example, if the US government bond yields 3% and country X's bond yields 8%, the risk premium is 5%. A higher risk premium means investors see more risk. Country risk also affects the exchange rate and foreign investment. If investors believe a country is risky, they will demand higher returns or avoid investing there, which can weaken the currency and reduce capital inflows. Now let's talk about GDP and economic growth. GDP stands for Gross Domestic Product, and it measures the total value of all goods and services produced in a country over a specific period, usually a year or a quarter. GDP is like the economic scoreboard of a country. It tells us how much economic activity is happening and whether the economy is expanding or contracting. But what exactly does GDP measure? GDP includes everything produced inside a country's borders, regardless of who owns the companies. For example, if a foreign company builds a factory in the United States, the production from that factory counts toward US GDP. GDP measures production, not income or wealth. It includes things like manufacturing, services, construction, and government spending. It does not count informal or illegal activity, and it also does not count household work like cooking or cleaning at home. Now let's explain the difference between nominal GDP and real GDP. Nominal GDP measures the value of production at current prices. That means if prices rise, nominal GDP can increase even if production stays the same. Real GDP adjusts for inflation, so it measures the value of production using constant prices from a base year. Real GDP shows true growth in output, not just price increases. For example, if a country's nominal GDP grows 10%, but inflation is 8%, the real GDP growth is only about 2%. Real GDP is the better measure for understanding whether an economy is truly growing. Finally, GDP per capita is GDP divided by the population. It helps us understand average economic output per person. GDP per capita is often used as a rough measure of living standards. For example, two countries can have similar GDP totals, but if one country has a much larger population, its GDP per capita will be lower, meaning the average person is producing and earning less. GDP per capita is not perfect because it doesn't measure income inequality or quality of life, but it is still useful for comparing economic performance across countries. Now, let's talk about business cycles and recessions. A business cycle is the natural rhythm of the economy. It goes through phases: expansion, slowdown, recession, and recovery. During an expansion, economic activity rises. People spend more, businesses hire more, and production increases. During a slowdown, growth slows down and the economy starts losing momentum. This is when businesses become cautious and consumers start spending less. A recession is when the economy contracts for at least 2 consecutive quarters. During a recession, unemployment rises, consumer confidence drops, and spending falls. This is the part of the cycle that everyone feels. So why do recessions happen? Recessions can happen for many reasons, but they usually start when spending falls. Sometimes investment drops because businesses expect lower profits. Sometimes a shock like a financial crisis. For example, the 2008 financial crisis began when housing prices fell and banks faced huge losses, which caused lending to freeze and the economy to contract. Another example is the COVID-19 recession, which happened because lockdowns stopped businesses from operating and people from spending. Now let's talk about recovery and growth. After a recession, the economy eventually starts to recover. Recovery happens when spending returns, businesses start hiring again, and production increases. Often, governments and central banks help recovery by cutting interest rates or increasing spending. For example, during the COVID-19 recession, many governments increased spending to support households and businesses, and central banks lowered rates to encourage borrowing. Growth returns as the economy moves back into expansion. Over time, the cycle continues: expansion, slowdown, recession, and recovery, because economies are dynamic and influenced by many factors like technology, policy, consumer behavior, and global events. Finally, let's talk about applying macro to personal finance and investing. One of the most useful tools for investors is the economic calendar. An economic calendar lists upcoming data releases like inflation reports, GDP numbers, and central bank decisions. These events can move markets because they change expectations about growth and interest rates. For example, if inflation comes in higher than expected, markets may expect higher interest rates, which can affect stocks and bonds. The goal of using macro in investing is not to predict the future perfectly, but to understand the environment and make smarter decisions. If you enjoyed the video, please like and subscribe to continue growing this awesome community. Thanks for watching, and I'll see you in the next